This conference will now be recorded.
Hello and welcome along to the Personal Insurance Advice What's Changed webinar. During today's webinar, we're going to be taking a look at the key updates to the standard. But before we do that, let's just take a step back and have a look at the reasoning for some of the updates. Stakeholder feedback is important to the continuous improvement process for the advice policy and projects team. We have taken on recent feedback received, and as a result, we have made changes in order to support the network. We would also like to take this opportunity to remind everyone that the updated standard and the support tools will be available and released on the 20th of September. So let's now take a look at these updates. On the screen, you will see a number of the updates, 5 of them. So let's have a look at each of them. We're going to go into more detail a little bit later. So in point number 1, we're going to provide clarity on the documentation requirements from a file and an SOA perspective when you go about completing cumulative cost comparisons for recommended products. We're then going to have a look at the modelling requirements, more specifically the projection rates that are available to utilise when you're undertaking modelling. We'll then have a look at the guidance that's been provided for conducting client reviews specifically related to insurance. Then we are going to take a look at revised terms, and specifically where the revised terms come back as exclusion only or a reduction in the premiums. Then finally, we're going to have a look at in what cases you may, and I will highlight may, be able to consider future events in the insurance analysis. Let's now take a look at each of these in more detail. Let's start first of all with the documentation requirements for the cumulative cost comparison. The client file and the advice documents, as we know, must contain financial projections, and the main reason for that is we needed to check to understand the long-term affordability of those policies for the client. Okay. This includes policies where we're making a recommendation to retain or hold effectively the recommended product, and it also relates to cover that is held in superannuation or where it is held personally. Now, just a point to highlight here, this is not to be confused with the projection requirements that we need for the advice formulation section of the advice process, where we are actually doing a comparison of products. For that section of the process, what we are doing there is we will actually be conducting modelling for all appropriate products, so products that could actually achieve the client's goals, but have actually but another product has actually been put in place in favour of those other products that we've considered. In that case, we just need to keep those projections for those appropriate products on the client file. Where we have actually made a recommendation, or we're making a recommendation, that needs to go in the client file as well as the advice document. So those projections do need to go in both places. That's our key takeout from this particular slide. When we're making a recommendation for insurance products, those financial projections we're running need to be maintained in the fact find and also in the SOA. For further details relating to this particular update, please refer to section 8.3 of the Personal Insurance Advice Standard. Let's now have a look at the options available when we're running projections. So as we know from the first release of this standard, modelling and projections are mandatory when we are providing insurance advice. So what we're now allowing is that we can choose from a couple of different methods when we're actually going to undertake those projections. So the first option we have is where we take the first year's premium and we index it by rates that have been provided to us by the AMP research team. Those rates apply to both stepped and level policies. So depending on what you're recommending, sorry, I should say irrespective of what you're recommending, it applies to both. And in addition to that, just be mindful that the indexation rates do actually vary from policy type to policy type. So for example, the TPD rate will be different to the life rate, which again will be different to an income protection rate. The second option that we have available to us is that we actually obtain the projected premium reports and we insert those into our system to do the projections. So what we can actually do is we can obtain these via an insurance quotes, or we can use comparative software. So for example, Risk Researcher in Xplan or Ink in Coin. Now, one of the reasons, or one of the items I want to highlight here is the reason why we're making this change. We've actually received valuable stakeholder feedback that there were challenges in obtaining these premium projection reports. Some providers simply did not provide them, whilst others actually could not provide the specifics that needed to be modelled for the client's scenario. Again, further information on this particular requirement can be sourced from section 8.4 of the Personal Insurance Advice Standard. Let's now take a look at the review process, and specifically relating to what process we need to follow when it's a review of insurance advice. So what will be dependent at this particular stage is whether or not you have conducted an affordability assessment for the client previously or not. Let's have a look at the requirements for each. So where you have previously conducted an affordability assessment, this effectively means you've previously looked at the suitability of the product and that the client can actually afford it. You must also assess whether they can continue to afford it. Okay, so what we're looking at here are things like no changes to the client's circumstances, and as a result of that, this potentially won't impact their cash flow, their surplus income, and hence their affordability to continue to pay for or cover the costs of those premiums. And as a result, we can rely on the previous assessment that was undertaken as evidence going forward because there's no change to the client's circumstances, that they can continue to afford the product. So what we can do here is we file note the assessment of the client's situation plus that analysis or that assessment, that revisiting of the continued affordability. So where it is a retain or a hold recommendation for a previous recommendation that you've given, modelling does not need to go in an ROA at the review stage. You can just keep a record of that on file. So what happens where you have not previously conducted an affordability assessment? So at this point in time, we actually don't know what the client situation is around affordability, or more to the point, long-term or ongoing affordability for this particular insurance product or multiple insurance products the client holds. So an affordability assessment must be conducted. And post conducting the modelling, hence the affordability, that must be kept in the client file, and we would advise placing it on in the advice document so the client actually does have it available to them, and they're informed and have all the information available to them as and when needed. Again, further information about the review process with insurances can be accessed from section 8.4 of the Personal Insurance Advice Standard. Now let's have a look at revised terms and potentially the use of a file note for this purpose. So before we get into the detail, there's a couple of things that we need to undertake in order to be able to utilise a file note where we have specific revised terms coming back. So the first one is, let's have a look at the criteria. So in one of these two scenarios, if one of these two scenarios are met, then the criteria of use, the first part of the criteria of use, have been ticked off. So where the insurer comes back and offers a decrease to the insurance premiums, now that could be because maybe they're extending the waiting period, or a shorter benefit period, or they're reducing the sum insured, or the policy is actually looking to have an exclusion, or the insurer is offering an exclusion on a policy that we've put into underwriting. And as a result of an exclusion, it doesn't impact the premium, the commissions, or the affordability. Okay, so let's just be mindful of those things going into our next consideration part of the process. So now we need to go through some thought processes and some consideration. So we've just received our revised terms back. They've met the criteria. What else do we need to do? Well, the first thing we need to do is think about, is this product with these revised terms still the an appropriate product for the client? Can we continue on with this particular recommended, like a retention or a placement, and this is still the most appropriate recommended product? So where we actually have done, we might go back and we might have a look at other products that we had a look at from an alternative products perspective and assess maybe some of the underwriters. We might ring them and see if there's other products that may be able to offer a better outcome from underwriting. So where we've done that, and then we've decided or determined that the product with these revised terms is still the appropriate product for the client. Once we've validated that, three things then need to happen. We need to file note the change. Obviously, we need to communicate it with the client, so we need to have that discussion with the client, and we need to complete any documentation or the process that the product provider requires in order to accept those revised terms. Now, in this particular case, because we have already given the client an advice document when we actually physically presented the statement of advice, the premiums, the commissions and affordability, all those components, they're already noted in that advice document. And as a result, these two revised terms items would either result in it being the same as or accurate, so i.e. under an exclusion, it's still going to cost the client the same amount of money, it's just that there's an excluded item or items, or it's going to be more conservative, i.e. less premiums being paid because the insurer is obviously offering something that's going to decrease the amount of premiums the clients need to pay. So as a result, we can rely on the previous advice document, and when these revised terms come in, we can utilise a file note. But don't forget, inform your client, complete the process for revised terms of the product provider. And again, further information on this component or this update can be accessed from section 10 of the Personal Insurance Advice Standard. And now to our final update. Here we want to have a look at when potentially future events may be factored into a client's needs analysis for insurance purposes. So as we know, and the stance of the licensee has predominantly been, or in the past been, that an analysis must always be based on the client's current financial situation. and there's been no allowances for potential future purchases or investments, debts, events, etc. However, what we are now looking to do is where the event is planned to occur in what we would deem to be the near future, and more to the point, there is evidence to support the occurrence of this event in the near future, then we will allow future events to be, as items, to be included in the needs analysis. So let me illustrate this further via a couple of examples. Let's have a look at example 1. Clients come in to see you and they've expressed an interest in purchasing an investment property. So the investment property's potential loan, i.e. the value of that loan, really should not be included in the needs analysis where the client's telling us, look, I'm only really thinking about it. My timeline for it is probably 2 to 3 years away. As a result, we know that that is an event that is not going to be occurring in the near future. However, where we had a client that has come in and we know they already have a deposit, they've received loan approval, and they're already out in the marketplace attending regular auctions and house inspections, there's a high likelihood that that purchase is going to occur in the near future. And as a result, the anticipated loan amount can be included in the needs analysis. So just to be clear, the evidence is clearly there to highlight the fact that this is going to occur in the near future. Let's have a look at another example. A client comes in or contacts you and advises that they're actually pregnant. As a result, it would be reasonable to conclude that items like childcare and educational expenses will be something that will come up in this client's future. And hence, as this is going to occur at some point in time or the near future, then we definitely are able to add that into the needs analysis. Now, like always, we need to think about trade-off conversations here. We need to also consider different goals the client may have, because the more money they are putting into premiums for insurances that potentially may not eventuate, reduces their ability to afford or meet other goals that they may have. Something you may want to consider here are products that actually allow the feature of increasing the sum insured over time. Again, for further information on this new update, please refer to section 3.7 of the Personal Insurance Advice Standard. So that brings us to the end of the actual updates. Just a few reminders as we conclude the session. The first one is you will see on the slide in front of you the location of the standards, tools and resources for the various different licensees within the AMP network. So please take note of those so you can definitely go in and access all of the materials. And just a couple of reminders or post-webinar activities. If you haven't already done so, please hop into the Elliott AMP system and complete the e-learning module relating to the Personal Insurance Advice Standard. And further to that, we strongly recommend that you go and review the updated or the actual updated version of the Personal Insurance Advice Standard in its current format. We want to make sure everyone does have the most up-to-date information. And that now brings us to the conclusion of our webinar. We would like to thank you for taking the time to review this webinar. We hope that you have found it of value, and we hope it supports your knowledge of the new updates relating to the personal insurance advice standards.